Many American working professionals are discovering that their fixed monthly payments, mortgages, car loans, insurance premiums, childcare, and 401k contributions are quietly shaping their career decisions more than their actual salaries are. This isn't about overspending. It's about how predictable financial obligations begin to define long term life structure. There is a financial shift happening across middle income and upper middle income households in the United States. It's not dramatic, it's not sudden, but it's measurable. Fixed monthly payments are consuming a larger share of professional income than they did a decade ago. And once those payments lock in, they influence everything: job mobility, risk tolerance, relocation decisions, retirement timing, and even personal stress levels. Let's look at what this really means. For many working professionals in their 30s, 40s, and early 50s, income has stabilized. Salary growth typically slows after the early career acceleration phase. Promotions become less frequent. Raises often fall in the 2 to 4% annual range, sometimes barely keeping up with inflation. At the same time, fixed costs solidify. Mortgage payments remain consistent, but property taxes adjust upward. Home insurance premiums have risen in multiple states. Car payments stretch longer than before, often 60 to 72 months. Health insurance premiums continue increasing, especially for families. Childcare and private education costs are locked in for years. Individually, each payment appears manageable. Collectively, they shape behavior. When fixed obligations rise faster than salary growth, professionals begin adjusting their decisions around stability instead of opportunity. Consider housing. A mortgage taken at a low interest rate during a favorable period may look affordable at the time of purchase. But property tax reassessments, HOA fee increases, maintenance expenses, and insurance adjustments often grow faster than wages. The homeowner remains stable, but financially less flexible. Refinancing opportunities may disappear if interest rates rise. Moving becomes more complicated due to transaction costs. A home intended to provide freedom can gradually limit mobility. Now look at retirement contributions. 401k auto enrollment and employer match programs have increased participation rates, which is positive from a long term planning perspective. But higher contribution percentages reduce take home pay today. For dual income households contributing 10 to 15% each, retirement savings become a fixed obligation, not a discretionary choice. This creates a quiet tension. Income feels stable, net income feels tighter. Then there is health insurance. Premiums, deductibles, and out of pocket maximums have steadily increased. For professionals not receiving heavily subsidized employer plans, annual healthcare costs can rival car payments. Even employer sponsored plans often see yearly premium adjustments. Unlike discretionary spending, these costs are contractual. They don't pause during economic slowdowns. Debt obligations add another layer. Student loan repayments resumed for many borrowers. Car loans are larger than historical averages due to higher vehicle prices. Credit card balances expanded during inflationary periods when groceries, fuel, and utilities surged. Fixed minimum payments become embedded in monthly budgeting. Once these structures are in place, the psychological impact begins. Job decisions change. Professionals may stay in roles longer than they intended because predictable income supports predictable expenses. Career pivots feel riskier. Relocation becomes financially complicated. Entrepreneurship feels less feasible. This doesn't mean individuals are financially unstable. In fact, many are technically earning more than ever. But higher earnings paired with higher fixed obligations reduce optionality. Optionality The ability to change direction without severe disruption becomes one of the most valuable financial assets over time. When fixed payments consume 50 to 70% of take home income, flexibility narrows. The structure hardens. Property taxes provide a clear example of structural growth. In many metropolitan areas, assessed home values have increased, pushing annual tax bills higher. Even if mortgage principal and interest remain fixed, total housing cost rises. Insurance markets show similar patterns. Home insurance premiums have increased in states exposed to climate risk. Auto insurance premiums have risen due to higher repair and medical costs. These adjustments don't feel dramatic month to month, but over years they compound. Meanwhile, salary growth at mid-career levels unless significant role changes occur. The combination creates a compression effect. The paycheck stabilizes. The obligations continue climbing. Healthcare is another factor shaping long-term structure. Family plans, deductibles, and prescription costs create predictable outflows that cannot easily be reduced. Professionals may prioritize employer stability over higher risk opportunities because insurance continuity matters. In earlier decades, professionals often aimed to increase income to expand lifestyle. Now, many increase income simply to maintain it. Inflation plays a supporting role in this pattern. When everyday expenses rise, groceries, utilities, services, they gradually shift from discretionary to semi-fixed. Subscription models across industries further convert optional purchases into recurring charges. Streaming platforms, software tools, maintenance plans, these accumulate. None individually reshape a career, but collectively they anchor monthly cash flow. This shift also affects retirement timelines. When a large portion of income supports fixed costs, the margin available for accelerated savings shrinks. Professionals may find themselves contributing steadily but not aggressively. Retirement becomes less about early exit and more about sustained endurance. There is also a generational component. Many mid-career professionals are simultaneously supporting aging parents and funding children's education. These dual responsibilities create long-term obligations that last years, sometimes decades. Again, not unstable, just structured. And structure reduces flexibility. Housing equity, retirement balances, and stable careers create the appearance of financial strength. On paper, net worth may rise, but liquidity and maneuverability tell a different story. Liquidity is often limited. Selling assets triggers transaction costs or tax consequences. Borrowing against assets increases leverage. Downsizing involves disruption. So professionals adapt. They focus on stability. They manage rather than expand. They optimize rather than reinvent. Over time, fixed payments quietly become the central organizing force of financial life. They determine acceptable risk levels. They influence job satisfaction thresholds. They shape long-term geographic choices. This doesn't imply mismanagement. It reflects structural design. Modern financial systems encourage long-term contracts. Mortgages, loans, insurance policies, education plans, retirement contributions. These instruments provide predictability. But predictability trades off against flexibility. In earlier career stages, income volatility might be tolerable because obligations are lower. Rent can change, locations can shift. Lifestyle adjustments are easier. Mid-career looks different. Mortgage underwriting standards, credit markers, and employment benefits all assume income stability. The system rewards consistency. Consistency requires structure. Structure requires fixed payments. And fixed payments shape life architecture. The key observation isn't that fixed costs are inherently harmful. They often support long term wealth building, home ownership, retirement accounts, education funding. The shift occurs when the majority of income becomes pre allocated before the month begins. When that threshold is crossed, decision making changes. Career choices narrow, financial experimentation declines, geographic mobility slows. For many professionals, this happens gradually. There is no single moment of realization, just an increasing awareness that monthly obligations define the range of available options. This pattern explains why many mid career professionals describe feeling financially stable but constrained. Income exists, assets grow slowly, but flexibility declines. Understanding this structure helps explain broader trends in career behavior across the United States. Lower voluntary job switching at certain life stages, reduced relocation rates among homeowners, delayed entrepreneurship. It also clarifies why financial stress can exist even in six figure households. High income does not automatically equal high flexibility. Flexibility depends on how much of that income remains uncommitted. Over time, predictable monthly payments create a predictable life path. That predictability provides security. It also defines boundaries. And in the modern American financial landscape, those boundaries are increasingly shaped not by income potential, but by recurring obligations that rarely shrink once established.